Hello everyone, this is Zahir. I welcome you to another episode of Accounting Lesson. Hopefully you are doing great. So today we are going to learn another very elementary but very important issue of accounting. So without any further ado, let's get into it. Today we are going to talk about revenue recognition principle and the matching principle. Those who are following my channel regularly, they will find it very similar to the very last lecture that was about accrual basis of accounting and cash basis accounting. In our last class, we learned that in accrual basis of accounting, the receipt and payment of cash is immaterial. It is important to know that whether the sales has been realized or the expense has incurred or not. So this lecture will be similar to the last one. Here, first of all, we will learn what is revenue recognition principle. According to revenue recognition principle, revenue has to be recognized when it is earned, and for service industries, when the service is performed. Suppose during the month of March, if we have sold a product and we have received the cash on April, then we have to recognize the revenue on March. But given that at that time the revenue was earned. But what are the criteria based on which we can say that some revenue has been earned and some are not? There are very specific criteria for this. For example, suppose in a sales transaction both the buyer and the seller has agreed upon a price and the seller is almost 100% sure that he will receive the money. Then the product is considered sold. In another example, suppose a seller has already delivered the goods to the buyer. In that case also, the sales is considered to be completed. So it is considered that the sales transaction is completed and the revenue should be recognized because it has already been earned. The main criteria here is whether the risk and return associated with the product or the goods that has been sold is with the buyer or the seller. If the risk and return of the goods has been transferred from the seller to the buyer, then it is considered that the sales transaction has been completed. So at that time we have to recognize the revenue even if we receive the cash at later date, maybe next month or next week. So this revenue recognition principle goes hand in hand with accrual basis of accounting. When we received or paid the cash does not matter. And when we learn revenue recognition principle, we must also learn another concept, that is matching principle. Matching principles say that expenses must follow revenue. You see, expenses are incurred to earn revenue. If I give you an example, this concept will be clear to you. Suppose today we are selling some goods or providing a service. Then there will be some expenses that are associated with the revenue, because to provide the service or sell the good, we must incur some wages. We will incur some expenses like rents, utilities, and other expenses. So accountants have come up with this concept that since expenses are incurred so that we achieve the revenue, so every expense must follow the associated revenue. If we recognize a revenue in the month of May, then all the expenses associated with the revenue must also be recognized during that month. That means May. We cannot defer the recognition of the expense, or we cannot recognize it in advance. It has to incur in the same period as the revenue was. So this is called the matching principle. So in a nutshell, we can say recognize the revenue when it is earned, not when you receive the cash. And at the same time, matching principle says that every expense must follow the associated revenue. So you must recognize all the expenses during the period you have recognized the associated revenue. Even if you have paid the expenses in advance or you are going to pay it at later time, you have to recognize all the expenses that are associated with a specific revenue in the same accounting period. When you recognize a revenue but you have not received a cash, you have to put it under accounts receivable account. And when you are not paying cash for an expense, you have to put it under accounts payable account. And when you pay an expense in advance, maybe 1 month earlier or 1 year earlier even, you have to put it under prepaid expenses account. And as you know, prepaid expenses are assets. If you are following my channel regularly, by now you should know that any expenses that is paid in advance, we put it under prepaid expense, and prepaid expenses are assets. If you are having trouble understanding my lectures, or if you are having any issues with accounting or any business related issues, please don't hesitate to write in the comment box. Friends, if my contents are helping you, please consider subscribing to this channel and share my videos with your friends. If you are having any problem in any business studies related subject, please don't hesitate to mail me or write in the comment box. I will try to explain that issue. So guys, share my videos and let's together make knowledge free again.